Is this all, and by this I mean the market's big drop in 2022, is this all the Fed's doing, or is it something else?
Well, I think it's a little bit of something else. We basically had a pandemic that just destroyed supply chains, and then a war with Ukraine that elevated oil prices. And I think most of what we're seeing right now is actually the effect of higher energy prices and food prices more than anything. And I think that's coming out of sanctions with Russia and just supply shortages that we have had that we were not able to replenish before Russia invaded Ukraine. And so everything that we've seen coming out of inflation that has been forcing the Fed into this corner has been really about energy and food prices and not about real wage hikes. We have seen some wage inflation, but it just doesn't explain the majority of the picture. And if we look at inflation, it's all about energy.
Yeah, well, it is. And obviously, we've been trying to sort of, ring that bell for a couple of years now in our reporting from the U.S. and around the world. But about 75% of the jump in energy and food prices, Gina, came before the invasion by Putin. Obviously, it accelerated a bit into the lead up as he amassed troops on the border there, and people sort of speculated what he might do. But we had inflation well before anything happened in Ukraine, did we not?
You are absolutely right, Brian. And much of that was really pandemic-related labor shortages that led to commodities supply shortages. And those supply shortages put us into a really precarious situation. In fact, if you look at the peak of inflation expectations, they occurred before the beginning of the year. They actually occurred in late 2021 when inflation expectations were actually at the highest. Believe it or not, inflation surprises have been surprising lower and lower. They're still high, and the numbers are still in absolute terms extremely high, but we have been trending down in terms of what is expected versus what we get.
Yeah, and I want to show, I don't know if we have this chart ready. I was doing it over the weekend. We're basically looking at sort of the run-up from when the Fed began, and Congress, fiscal and monetary stimulus. Guys, thank you very much. From the pandemic lows back in March of 2022, and then, of course, we saw the fiscal and monetary stimulus, the S&P 500, it more than doubled. It's up 110% from the low to our recent high. Gina, we're down. I mean, I know it's painful right now, but we're only down 14% off that top. I mean, it feels like the Fed and Congress giveth, and maybe now they taketh away, and that's a market that looks like it doesn't have a lot of support. What do you think is going to happen going forward? Could the Fed flip, get more dovish, and try to protect the equity market?
Well, I don't think the Fed is going to try to protect the equity markets, but I think that the Fed could get some more evidence of softening inflation and softening demand. The thing about energy prices is remember, they act as a tax on consumption. So they can only remain elevated for so long, and then like a parasite, it will kill its host. So they will always come back down. And I think that if wages stay put and don't continue to accelerate, I think the Fed could actually have some room to maneuver by the fall.
Well, in the UK, by the way, in the UK, your utility bill resets twice a year in April and in October. The head of one of the biggest utilities this morning came out and said expect maybe another 1,000 British pound jump in the utility bill at the October reset. We were talking about this in November last year. Not saying that's going to happen here to that extent, Gina, but energy prices this summer, I think a lot of people are going to have sticker shock, not just at the gas pump, because gas, by the way, is at record highs, but also electricity-wise. So it sounds like you're saying that energy costs are going to, no matter what else happens, may keep the Federal Reserve jumpy, for lack of a better term.
Absolutely. Energy costs are going to cause a slowdown much faster than the Fed can do through rising interest rates and tightening lending standards. Energy costs are going to cause people to absolutely step back. And we haven't seen, there's been so much pandemic pent-up demand, but that's been slowing. Add on to that excess prices. I mean, right now it costs more to fill my Jaguar right now than it costs to buy a barrel of oil, which is still sort of mind-numbing to me every time I go to the gas pump. And so, that will, continue to keep demand at bay, and it's going to cause a quicker slowdown.
Yeah, well, having been out west, and I know it was a nicer area of L.A., Gina, but seeing that $6.50 and $6.75 a gallon up on that screen for self-serve, not by the freeway, wow.